the statement of stockholders' equity is important because it tells you why a company's equity accounts changed from one balance sheet date to the next balance sheet date. If you look at a company's balance sheet as of December 31st, 2021, you'll see all its different stockholders' equity accounts. You'll see common stock, retained earnings, and any other equity accounts the company happens to have. But it won't tell you why those accounts have increased or decreased since the last balance sheet date. And that's what you're going to find on the statement of stockholders' equity. So let's do a really, really simple example for this company, Rubber Monster, and they just have two equity accounts. They've got common stock and they've got retained earnings. So we've got a real simple statement of stockholders' equity here that we can easily understand. So our balance in the account, so we've got our common stocks, so these are in thousands, so it'd be $2.5 million at the beginning of the period, which was December 31st, 2020, and then at the end of the period, it's also $2.5 million. So there's no change to the common stock account here, okay? Nothing happens. Retained earnings, on the other hand, we see that it begins at $6.305 million and ends at $8.605 million. The question is why? Why on this balance sheet date is it higher than the previous balance sheet date? And so we can see that there were a couple of things that happened here. Okay, so we had net income that occurred during the 2021 fiscal year of $3.3 million. So that's going to increase the retained earnings balance. And then there were some dividends. Okay, so there were some dividends of $1 million. So the ending balance of retained earnings is the beginning balance plus the net income minus the dividends. That's how we get to here. So you can see that. And so we got two accounts, common stock, retained earnings, and now you know why they changed. The common stock account actually remained constant. The retained earnings account went up. Why? Because they had some net income. Now, it went down a little bit because of the dividends, but there was more net income than dividends. So the net effect is that retained earnings increased. Okay, let's do a real example. So let's take a look at Home Depot. So it's a little more complicated because this is an actual company here. So they've got 5 different accounts, though. Let's break this down. So here's their statement of stockholders' equity. Okay, and they actually have for the last 3 periods, but let's just focus on fiscal 2020, what happened to their equity accounts during that period. So I've already labeled the 5 accounts. We've got common stock, additional paid-in capital. Remember, those two together represent amounts that were put into the company by investors. Okay, so that's contributed capital by investors. They contributed money to Home Depot in exchange for stock. Now we've got retained earnings, and then we've got accumulated other comprehensive income, and then we have treasury stock. Remember, treasury stock just means the company bought back some of its own shares. So we've got 5 different accounts here, and for each account, the statement of stockholders' equity is going to tell us what the beginning balance was. So we see, for example, common stock balance at beginning of the year, so balance at the beginning of the year, and then the balance at the end of the year, and some things that happened in between. So let's take a look at retained earnings. So at the beginning of the year, so for fiscal 2020, at the beginning of the year, they had $51.729 billion, because these amounts are in millions, $51.729 billion of retained earnings. And at the end of the year, the retained earnings balance, $58.134 billion. So it went up, okay? It went up by several $billion, almost $7 billion there. So what happened? Well, was there a cumulative effect of any accounting changes that affects retained earnings? No, not this period. There were in some prior periods, but not this period. That's not what happened. Okay, next thing, net income. There was $12.866 billion of net income during the period. So that's going to get added to the beginning balance of retained earnings. Now we had some dividends, which are going to be subtracted. And then we have this thing, other. It looks like just a $10 million reduction in retained earnings. If you were curious what that was, I would go to the notes. Maybe they have a disclosure about it. So we got our beginning balance of retained earnings plus the net income minus the dividends and minus this $10 million other, and that gets us to our ending balance of retained earnings, $58.134 billion. Now, this amount right here, if you were to go to their most recent balance sheet date, right? So at the end of fiscal 2020, when they put together their balance sheet date, their balance sheet, you would see that number in the equity section. And if you went to the prior year's balance sheet, okay, the prior balance sheet date, you would see this number. What you don't see in the balance sheet is you don't see this action in the middle. You don't see why the retained earnings account changed. So we go to the statement of stockholder equity, and for each of these different equity accounts, we could see exactly what happened during the period of why the account went up or down.